Welcome back to A Smarter Way to Retire. I'm Tony Leonardi, your certified financial planner, here to help you navigate the world of the markets and the economy to help you secure your dream retirements. This past week, markets hit record highs, but tariffs and inflation are keeping us on our toes. And overnight, a U.S. Japan trade deal shook the markets, while inflation and tech keep us guessing. Let's make sense of it for your retirement. So I'm still technically on family vacation on the beach in Rhode Island. And last week we had the surprise engagement party for my son Tony and his fiancee Maddie, and we pulled it off. They were totally surprised, and it was great to see them together and so happy. We had a real New England lobster bake. Lobsters, corn, potatoes, oysters, shrimp, clams on the half shell. It was really a great night. I have to admit, I got a little emotional for the first time over this wedding coming up next year, which was a surprise to me. I guess I'm just a big softie when it comes to my kids. So again, congratulations to Tony and Maddie. If you haven't been to the beaches in Rhode Island, you have to check them out. They are really spectacular. I know that the beaches in, let's say, New Jersey, the Jersey Shore, are very popular. And I've been there. The beaches in New Jersey are fantastic. But I love the beaches in Rhode Island. They're less crowded, less commercialized, more natural, I would say. I love that New England feel. The water was actually turquoise blue this past week, almost like you'd find in the Caribbean, but not quite as warm. 71 degrees or so, which is refreshing. We did a little bit of fishing off the beach and just are having a great vacation. So I hope you're enjoying your July as well and enjoying some vacation time. Let's talk markets. The Nasdaq soared to a new record, up 1.5% last week to over 20,700, fueled by a 4% spike in Nvidia after the U.S. greenlit its AI chip sales to China. That's huge news. Palantir stock is up unbelievably, a jaw-dropping 100% this year so far, doubled, riding the AI wave. Does that mean you should have all of your money in AI stocks? No, of course not. If you're retired or on your way to retirement, remember, diversification helps reduce risk. Because not all tech is thriving. Texas Instruments slumped overnight as tariff fears hit chip demand, according to Market Screener. This is why diversification is the key for your retirement. Remember, don't chase stocks. Stick to your plan. The S&P 500 inched up last week slightly to over 6,300. The Dow slipped slightly, dragged down a little bit by tariff fears. Material stocks like 3M dropped 3.7%, according to Reuters, as Canada's potential 35% tariff looms. Here's the good news. Strong earnings are keeping the mood upbeat. JP Morgan Chase, Citigroup, and Johnson & Johnson all crushed their Q2 earnings, with earnings per share beating estimates by up to 49 cents. Retail sales also popped 0.3% in June, and housing starts hit 1.32 million units, beating forecasts. This consumer strength signals a resilient economy, which could lift your retirement portfolio, especially in financials and healthcare. We know that the U.S. economy is overwhelmingly driven by the U.S. consumer. When the consumer is happy and spending, the economy does well. And the consumer seems to be happy and spending right now. Great news. But hold on, what about inflation? The consumer price index hit 2.7% for June, up from 2.4% in May, according to Dow Jones. Core inflation's at 3%, above the Fed's 2% target. Doesn't sound like a lot, especially considering where we've been in inflation over the last few years, up into the double digits not too long ago. Lower inflation doesn't mean prices have come down. Lower inflation only means that prices are not rising as quickly as they were, but they're still rising. I'm sure you've noticed this when you've been out shopping, especially at the grocery store. Inflation could eat into your bonds and raise costs for travel, groceries, healthcare, and retirement. The producer price index stayed flat, which was good news, offering some relief. But Fed Chair Powell's speech at Jackson Hole gave no clear hints on rate cuts, keeping the markets guessing again. We really need to get inflation down substantially under 3%. That would do wonders for your retirement models. Anything over 3% is really hard to deal with. On the trade front, the Trump administration pushed the tariff deadline to August 1st, with talks ongoing for 15 to 20% tariffs on the EU, down from 30%. These tariffs, plus Canada's potential 35% and Mexico's 30%, could raise prices more for groceries or tech gadgets, according to Goldman Sachs. But there was some big news overnight. Trump struck a tariff deal with Japan, sending auto stocks like GM soaring. The Nikkei and EU stocks also rallied as trade war fears eased slightly. This could ease price pressure on your retirement budget and maybe boost small cap stocks, especially if EU talks follow suit. So the tariff war continues on its roller coaster, but progress is being made. The markets don't like uncertainty, but they do like progress. Bloomberg says tariff revenue could bring in billions to the U.S., and if so, that would be a big win for market stability and your long-term investments. So we're really keeping a close eye on this. Globally, I'd say it's a mixed bag. China's Q2 GDP softened, but Hong Kong's Hang Seng is still up 23% this year. Pretty good return. And that's great for your international holdings, your international ETFs, if you have them. The ECB held rates at 2.15%, and the euro is holding strong after trade talk optimism. International stocks are really trouncing U.S. domestic markets so far this year, and it's a good idea to have some international exposure for diversification purposes, but keep global exposure reasonable, around 10 to 15% maybe, to dodge surprises. You never know what's going to happen. Remember, don't chase, stay disciplined. And those rumors about Trump firing Powell, he shut them down last week, but the chatter spiked volatility. Remember, stick to the facts and let's plan smart. So how do you turn this week's chaos into opportunity for your retirement? Here's your playbook. Maximize tax savings. The One Big Beautiful Bill Act locked in the lower rates, 24, 32%, which I think is where most of you are going to fall, saving you several $1,000s potentially in taxes over the year. Reinvest that into a Roth IRA if you're eligible, or maybe into a healthcare fund. Put that money to work. Work with your CPA to tweak your 25 withholdings so you're not overpaying. We don't need to make interest-free loans to the government. Ride the tech wave, but don't overdo it. AI stocks like Nvidia and Palantir are really soaring, but diversify to avoid surprises like Texas Instruments. Diversification is the key to stable returns over time. So you can allocate a percentage to tech ETFs for growth, but balance with stable bonds, value stocks, international stocks as well. Balance is the key. Beat inflation. CPI at 2.7% now. You need a hedge against inflation. Stocks historically have been the best hedge against inflation over the long haul, but they come with volatility, obviously. Another way to help protect your portfolio could be with inflation-linked bonds or real estate. Real estate could also snag the bill's 23% Section 199A deduction, saving you potentially thousands in taxes. Talk to your CPA if you have investment real estate. Leverage tariff revenue. Tariffs could stabilize the markets by cutting the deficit. Hold some small cap stocks which thrive under the bill's business-friendly rules, like immediate equipment write-offs. that could prove invaluable. But don't forget to balance between growth stocks and value stocks as well. Remember, diversification is the key. Stay grounded. Ignore all of the noise in the news, and there's a lot of it. Like the Powell firing rumors and the Colbert show being canceled. I'm not really sure what that has to do with the economy, but it's been a headline most of the week, with some senators even chiming in on the late night game. It's all noise, avoid it. Instead, use your modeling to guide you. We use Money Guide Pro in my office. Talk with your advisor to stress test your portfolio for tariffs and inflation, keeping you on track for retirement. So markets are up, tax cuts are in. Tariffs and inflation tell us that you need a plan, a model. If you don't have a model, you're flying by the seat of your pants. And if you don't have a model, let me know. I'm here to help. Grab our free 2025 tax planning checklist at LeonardiFamilyWealthcare.com. Follow us on Instagram or Facebook, LeonardiFamilyWealthcare.com for more tips. Are you ready to secure your financial future? Schedule a consultation today. There's a link to my calendar on my website. So let's plan smart, retire happy, enjoy these last few days of July. Summer is passing by like a blur, like it always does. Take some time to enjoy it. It'll be autumn before you know it. I'll catch up with you next week. Have a great week.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.